So today's session, estate taxation can be a complex area of taxation law which can be strewn with risks for both financial advisors and the client. So this session, taxation of deceased estates, clients for life, there's a good balance between technical, practical and storytelling. We know death is certain, but how equipped are you to help your clients and their families when they need you the most? Expanding your role will help develop further, deeper relationships and have clients for life. Our speaker, Ian Raspin, is the National Chair of the Society of Trust and Estate Practitioners, STEP, a global professional body of practitioners from multidisciplines who specialise in trusts, estates and intergenerational transfer of wealth, an area very much akin to us financial planners. He is also the Managing Director of B&R Partners, who specialise nationally in the taxation of deceased estates and trusts. He is recognised both nationally and internationally on Australian estate taxation matters, being both a published author, you'll notice the book at the back, on estate taxation, and he's a frequent presenter in both legal and accounting professions. He also consults with professional bodies, regulators, private sectors on estate taxation issues. He's a fellow of the CPA and the CA, and a certified tax advisor of the Taxation Institute of Australia, which is great, a registered practitioner of STEP and a graduate member of the AICD. He also sits on the CPA's Australian Taxation Centre of Excellence and on the advisory committee for the College of Law for the Masters of Applied Law programs. He's a major cyclist enthusiast and also enjoys a good drop of red wine and whiskey. Welcome to the stage, Ian Raspin. Thank you.
Thank you. Appreciate it. Good afternoon, everybody. Is that mic working? Yep. Awesome. Thank you for joining us in the last session this afternoon. It's always a hard one, the last session, but I hope you get something out of this. Today, as was just sort of spoken about, I'm going to be talking about death and taxes. And this is a big growth area in Australia. I'd have to say, as a member of STEP, we have a lot of different memberships, and I'd have to say that financial planners as a whole, the relationship that you guys have with your client is really unparalleled to any. And it's something as a profession I think you can be very proud of, and it's for that very reason, that the value of that relationship that you have, that your clients, whether they're going through estate planning or when somebody dies, they're going to turn up to you to start talking about what happens now. What happens to tax? What happens to my estate? And today what I'd like to do is to build a little bit of a framework for you around what happens on death and taxes. I'm not going to get overly technical or go into legislation or case authorities. There are some books at the back where you can take all those references if you'd like those. Those books are available for you. But today I'm just going to go through some of the issues. What I'd like to do though is just get a bit of a feel of your audience. If you could put your hand up for me, if let's say the last 2 years you've had up to 5 clients in your client portfolio pass away. Wow. 10? 15? Wow. Oh, wow, you're a hero. Okay, so that's massive. So put your hand up again if that estate administration had any problems with it. Problems with lawyers, advisors, claims against the family. Yeah. Okay. Now, sadly, from a tax law perspective, which is what I'm going to speak about today, a lot of accountants don't understand it. The tax revenue collected from this area is 3 to 4% of overall tax revenue in Australia. And so a lot of accountants do not understand this particular area. And sadly, also lawyers. So I'm hoping to be able to give you some takeaways today. Some of it will just be a refresher for some of you. Some of it might be a holy cow moment. But hopefully everybody will have something to take away from today's session. So what we're going to do is we're going to talk around deceased estate tax liabilities, what happens, for the pre-death sort of period. We're going to talk around the estate side of things and what you need to do from an estate side. 2 of the largest estate assets, capital gains and superannuation as well, and polish this off with a little bit of a case study at the end. I'd like to build a little bit of a framework around the landscape we're talking about here. This is our mortality rates in Australia. And you can see 2017 we had 140,000 people in that year alone die. Bring that all the way down to 2022, 190,000 people, 521 people per day. These are real numbers. We've got an ageing population and this is going to continue to grow, as is the complexity of these people's estates. Value of inheritance, you can see there, 2002, $48 billion in a year. Billion, not million, in a year. By 2050, they're projecting This is the Productivity Commission report, $224 billion of inheritance in that 1 year in Australia. This is massive. And when we start looking at your client bases, you guys are probably dealing with middle to high wealth families. And so a lot of that's going to start impacting on your client base. And if you can have some of these skill sets and some of the understanding on tax, while you can't, unless you're a tax advisor and licensed to provide tax advice, you can't necessarily provide it. You can certainly oversee it. You can certainly give some comfort and explain to people what's going to happen and make sure the advice they are getting is somewhere near what it really should be. So what do you have to do? An LPR. So an LPR is an overall term that covers, it's a legal person representative, it's an executor, which is granted by grant of probate of somebody's will, versus an administrator, which is when you die intestate and you don't have a will. So LPR is what I'm going to refer to sort of like colloquially deal with that. Obvious thing, as soon as somebody dies, notify the ATO they're dead. All of a sudden those notice of assessments or notices from the ATO are going to stop going to where they are and hopefully go to somebody that actually needs to know what the tax activities are and what needs to happen. Lodge outstanding tax returns. Now this sounds pretty simple, and you'll see in a moment that the executor is actually personally liable for this stuff. So you need to go and lodge the outstanding tax returns. The worst I've had is 35 years worth of outstanding tax returns. And this person, it was a Victorian person, actually had 2 businesses in their own name, so they're also registered for GST. The executor was personally liable and couldn't administer the estate until they've dealt with all of those sort of things. So these are really, really important areas. Date of death tax return today, 21st of November, I think. Somebody correct me if I'm wrong. If I die today, touch wood I don't, you need to lodge a tax return from 1st of July through to the 21st of November, and that's my date of death tax return. This room would all appreciate, we all get $18,200 tax-free and progressive marginal tax rates. My year of death, I get that even though I'm only alive for 5 months. I get $18,200. ABN and GST registration, you go back to the issue I just spoke about that person with 35 years. You need to cancel at date of death the ABN and the GST registration of the person that's just passed away. Not an inter vivos trust, a family trust or a company, that's separate, but that individual, those registrations need to be cancelled at that particular day. And as you'll see in a moment, there's some carry-on that goes on from that. And clearly, you need to pay any outstanding tax debts before you actually extinguish the estate. I would implore you when you're doing this and you're talking to accountants that are looking at it, we have a tax integrated client account. There are these areas in there called legal suspension accounts. And somewhere down there 2, 3, 4 years ago, they might have a $50,000, I had one of these in Queensland, a barrister, a $50,000 legal suspension account. They zeroed it and they just had a little note in there that this is a legal suspension account. And when this person actually died, the ATO reinitiated that $50,000 debt. And it wasn't picked up by the accountant. So just watch out on those sort of things as well. So date of death tax return, what are you going to do here? So really don't get confused about this being a date of death. Just think about it, well, if this was me, what would I have to do? Okay, so if any tax has been withheld as an individual, from wages or anything like that, it's probably a fair sign that you want to really go through and lodge a date of death tax return. Franking credits, a topic well and truly known to this audience, but you'll find old ladies, and I have a number of these, a widow, she's living off the age pension, has a little share portfolio off on the side, hasn't lodged tax returns because she doesn't believe she needs to lodge tax returns. Every one of those years might be worth $2,000 in franking credits. So it's worth going back and saying, okay, what's really happened over this tax history? And if you can soon accumulate $20,000 or $30,000 worth of extra revenue by just claiming those franking credits. $18,200 I sort of spoke about. If the deceased was conducting a business, hairdressing salon or something in their own name, it doesn't matter if it's a loss, you still have to go and lodge a tax return in that particular place. Now, if you look at this and you go, well, actually, I really don't need to lodge a tax return, there's no income. You can lodge what we call a non-lodgement advice, and that's a little form that's available on the ATO website, and you can lodge that and say, hey, Mr. Commissioner, I don't need to lodge a tax return, please just make note of that. We have this problem though, we have these problems where not everybody gets their tax affairs right. You've probably got clients, that you think they're reporting their income, but maybe they're not reporting all their income. Maybe they're not reporting the capital gain on some shares or a property they had, or maybe they're not even declaring the rental income on properties. And I've certainly had many of estate. We deal with about 5,000 estates a year around Australia, and many of estate people will not declare that income or offshore income. So you need to start looking at that. But the problem is that the executor has this responsibility to check that and to deal with those issues before they finalise the estate administration. And what we were finding was happening across Australia is that executors were actually going through, they were finalising the estate administration, lodging tax returns, and then waiting 2 to 4 years before they'd finalise the distribution of the estate. And the reason they were doing that is it's either 2 to 4 years on which those tax returns can be amended and they can be held personally liable. Now, this was playing out around Australia. It was starting to interfere with the courts because people were making applications to courts. There were irate beneficiaries and executors, beneficiaries needing the money where the executor's going, I'm not going to pass it out because I could lose my house. And so what we did, we worked with the ATO. There was 3 of us. We came up with PCG 2018/4. And this is a really bit of a safe harbour. It took us about 18 months to get this in place. And this safe harbour basically said, well, hang on a minute, that's not going to apply for a lot of estates. So if we can get a really simple estate, why do we need to worry about 2 to 4 years? So it's a bit of a safe harbour, and that's going to apply to a lot of deceased estates in Australia. So one of the things that you need to be able to enter this particular safe harbour is that you have probate or letters of administration. Now you'd all go, that's really simple, except for any of the Queenslanders in the room, because Queensland is a jurisdiction, you don't need a grant of probate or letters of administration to administer many estates. So it might be worth in that jurisdiction to actually go and get that to be able to give yourself this coverage. In the last 4 years, the deceased can't have been carrying on a business in their own name or a beneficiary of a discretionary trust. And the assets of the estates include public shares, superannuation, real property and cash, not private shares. So if you fall into that sort of area, the estate value is worth less than $5 million. That there, ladies and gentlemen, is just about to go up to $10 million. Consultation's just changed on that, so that's even going to capture more estates in this area. And you're not a member of a self-managed super fund. That was a bit of a stinger they came up with right at the end. And a number of your clients will be. Well, in that particular area, you're able to say, well, my exposure, if I lodge the tax returns, is now only 6 months, not 2 years or 4 years. And therefore, you can move this thing forward. Really important too, though, is that there's no tax-advantaged beneficiaries. Tax-advantaged beneficiaries, charities, DGRs, non-residents, etc. So you fall into that sort of regime and you're saying, hey, this is really comfortable, I'm okay on that, I've lodged the returns, I've got 6 months. Now that can apply unless one of these things come up. Number one, you've got a tax debt. So you're on deemed notice that there's a tax debt here, you need to pay that debt before you can close this thing down. Waiting on notice of assessments, the deceased may have lodged 3 tax returns before they died. You have to wait for all of those 3 tax returns and your date of death return before going through on this. Material irregularity. So again, I sort of said, like if somebody's got a rental property and hasn't declared the rental income, you should know that. You are obliged to actually have a look at their tax affairs, you know what their assets are, have a look back and say, hey, is everything okay? And whether you did or not, if a reasonable person would have picked that up, you're on notice and the 6 months doesn't apply to you. Now, a lot of estates, and somebody will see them, I have another one, I think it's New South Wales. 15 years after the estate administration had finished, a property turned up that nobody knew about. All right, that was worth a bit of money. All right, so the executor of the original estate is still the executor for life, effectively. So they had to go through and administer that property. And in that case there, where other assets turn up, you can't rely on the 6 months sort of rule, which is fair enough. So estate tax. Really, really important, ladies and gentlemen, is that the deceased estate is a separate legal entity. And so it needs a separate tax file number. You need to lodge tax returns. So financial years apply 30th of June, as every other year. And for every year your estate admin can go on. People like to think estates might take 3 months to administer. I have some in my office which would be in excess of 20 years. All right, so sometimes these things get complicated, particularly around litigation. So you can just continue to lodge that particular tax return. The ABN and GST registration, remember I said we had to cancel that at date of death and so forth. The estate needs to pick that up too. So if you're going to continue to trade a business through the estate and the revenue is above $75,000 per year in the individual's name or now in the estate name, you need to go and register for GST. Now a business, commercial property, just put your lens on this for a moment, a commercial property, office building, that's actually business for GST purposes. And so you need to now go through, and even though you're only collecting passive rent from a commercial property, you need to register the estate for GST as well. Now if you fail to do that, there's going to be a deemed disposal for GST purposes at date of death of all of the inventory and all of the assets that were used within that particular estate or by the deceased person. And so you might have $400,000 worth of inventory and assets Well, all of a sudden, you're up for a $36,000 GST bill if you don't go and actually go and do that. You're also subject to a deemed disposal of stock. So if you don't elect in the tax return of the deceased that I'm going to roll this over and then elect the same thing in the estate return, I'm going to continue to trade, we're going to move that stock through, there's going to be a deemed disposal for tax law purposes, and you'll have to pay tax on that, even though you've still got all of your stock. So just a little bit of a tricky area to go through there. Clearly you need to pay tax. Now if you pay tax and you do an interim distribution out to a beneficiary, which I'll touch on in a few minutes, and it's going to say a minor or somebody with a legal disability, you need to actually pay tax on their behalf as well, which is a separate assessment notice. And it might sound really strange, but just imagine an estate, mum dies, okay, there's 6 kids, big family, 6 kids, and you give every one of those kids a bit of money. Well, because they're a minor, the assessment notice is going to be against you as the executor. So you're going to get 6 assessment notices in 1 year for those kids, plus 1 for the estate. That's 7 assessment notices. And you need to pay tax on all of those. So just an area to watch through there as well. So the estate is actually not a trust at general law purposes, but for tax law purposes, it is actually treated as a trust. And it's captured under Division 6 of the Act. Now what happens here, a lot of you will be used to inter vivos trust, your family trust, and you never want to accumulate income in a family trust because you're going, it's 47 cents, no CGT discounting. All right? That's what we call Section 99A. Deceased estates is one of the 2 trusts in Australia that actually has Section 99 that can be applied. And Section 99 for the first 3 years of estate administration is the same of all of us. We get 18,200 tax-free and progressive marginal tax rates. Now again, if I die today, there's 18,200 for me as a living person, and my estate gets 18,200. It's not prorated. 36,400. Christmas Day or New Year's Day might be a really good day to die, to be able to balance that out. Now that process is going to go on for 3 years, 3 tax years. So if I die today, it goes to 30th of June, so that's effectively 7 months, and then another 2 full financial years. And thereafter, the 18,200 doesn't apply, but you still get progressive marginal tax rates. What I want to make really clear to you guys, and just put in the back of your head please, is that Section 99 is at the Commissioner's discretion. Okay? He'll always grant it in most cases. But if he gets a whiff that you're actually delaying estate administration because the beneficiary's tax rates are up here and the estate's is down here, he has the right to turn around and say, I'm not going to use Section 99 at all on this estate. It's Section 99A, no CGT discounting and highest marginal tax rate on every single dollar of income earned. And the amount of professionals I see around Australia that just think that they can delay estates for that purpose, just to save a little bit of tax, is off the scale. So it's just an area to sort of watch on through there as well. So it's a High Court case, Whiting's a case, and this is what the ATO used to sort of say, well, how do we apply tax to a deceased estate? They've taken Whiting's case, they put it into IT 2622, and they look at a deceased estate and they divide it into 3 really clear sections. Section number 1, I die. Okay, you run off, you try and get a grant of probate, you're trying to work out where all my assets are, my liabilities, even if I'm solvent. You're trying to work all that out. During that stage, it's going to be taxed against the executor, against you as the executor. All right? We get to the middle stage, so now you've got an idea of what assets I've got, what liabilities I've got, whether you're solvent or not, and so you're now going to pay some of those debts, sell a few assets, just deal with general administration stage. At that stage, again, it's going to be assessed against you as the executor unless you turn around and you make an interim distribution out. Now, families want money. That's fair enough. So if you turn around and make an interim distribution out to a beneficiary, you are also making them presently entitled to a share of trust income. Which means when you lodge the tax return, you need to say, look, we earned 50 grand for the year, but there's 5 grand each that went out to these people here, therefore they have to get a share of all the franking credits and everything else that goes with that. And you need to lodge the tax return on that basis to be able to do that. There are special rules there around, and I just want to emphasise this too, around charity. So you'll find Australia gives about just over north of $1 billion a year through testamentary gifts to charities, not-for-profits. They might be DGRs or non-DGRs, just over $1 billion. Now these charities are waking up to this. It's big money. And they're turning around and going, hang on a minute, we're receiving all this money from estates. How do we know the executor's doing the right thing? Now there's 3, in fact there's a 4th I discovered last week, organisations around Australia that are actually now representing the DGRs. And so they're turning up to the party at the end of the estate administration and going, hey, I know I'm going to benefit from this estate, but why did you pay tax? If you'd rearranged the affairs differently, or you dealt with the capital gains, or you may be specifically entitled or transferred the capital gains to me, depending whether it's a DGR, then there wouldn't have been tax. And they're pursuing lawyers, accountants, financial planners, trustee companies right around Australia. So if you have an estate with a charity in it, it's a big red flag to get some professional advice and just monitor how you actually deal with the tax on it. Or you might be getting a visit in relation to your PI cover, unfortunately. So I spoke about liability of an LPR. Basically what goes on through here is that many years ago we used to have this thing called a tax clearance. So we go through and we lodge a tax return, we'd send a beautiful letter off to the Commissioner and say, dear sir, finish the estate return, can you please just confirm for me there's no other outstanding liabilities for you? He'd write back and go, yep, that's all great, and you stick that in the safe, because if you've ever turned up, you've got a get out of jail card. They stopped this when they removed the Chapter 32, which is the receivable policies, back in 2011. And some people still don't know this. Now, put that on ice for a moment. Go to a 1958 High Court case, Brown's case. And Brown's case, what happened is the Commissioner decided the estate had been administered, the money had been given to the beneficiaries, there was tax to pay, there was nothing left in the estate, so the Commissioner went after the beneficiaries. He lost all the way to the High Court. And that really put the focus back onto the executor, who's now personally liable. In fact, the Tax Act, Section 254 of the Tax Act, makes the executor, stands in the shoes of the deceased, but is personally liable for outstanding tax if they distribute the estate assets and there's subsequently a tax liability. And that's why estates were being delayed for that 2-4 year period that I was talking about earlier on. So now there's this real big uncertainty around, okay, what's the liability of an executor? So there's a question here to say, well, should I lodge a tax return? Because you remember I told you there was the 2 to 4 years. And that's based on lodging a tax return. If you lodge a tax return, you're only now exposed, depending on the complexity, for a period of 2 to 4 years in relation to the pre-death periods. So often I said you could lodge a return, not necessarily the ATO one-page document, which locks that away. But that's not a tax assessment. And so by going and lodging a tax return, even if you declare $100 worth of income, if that's the only income you got, or zero income, the clock starts ticking. Yes, there's an argument that says, but it costs to lodge a tax return? Absolutely, but it's an insurance policy. If you don't lodge that tax return on the other side, you're exposed indefinitely, retrospectively, across all those tax affairs. So a little bit of an area there. Clearly, fraud and evasion, if there is fraud and evasion, that period's unlimited. But as an executor, if you've looked over the deceased affairs and had a look at those and they seem reasonable and a reasonable person should have come to the same conclusion, you're not going to necessarily be exposed to that. It's going to be more if you committed fraud and evasion, which as professionals clearly we wouldn't be doing. So then we've got to go, well, how do we deal with this? This is really actually pretty damn scary. When you get a tax return, a deceased person or one of your clients die, get the tax agent to go out and do a look at their tax history. Look backwards, see how many tax returns are outstanding. Have a look for that suspended legal action account and deal with all of those and then retrospectively deal with every one of those. If you find the client they're all outstanding on the ATO portal, that means there's probably even more outstanding retrospectively than what the ATO is actually telling you about online. Notice of assessments, wait for those notice of assessments to turn up and pay the tax if you at all can before you actually distribute. Reality is beneficiaries again want money. So they turn around and say, look, I need to pay the electricity bill. They used to be able to pay, but they want money now to be able to pay it, right? And so you get pressure. And so they're going, give us money, give us money. Well, if you turn around and you say, well, actually, this is reasonable. I don't need all this money or this wealth. I can give you some. Work out what your tax liability is before you do it. And there's an industry practice across Australia with lawyers and trustee companies, listed and public. And what they actually do is they'll turn around. If I said, hey, there's 50 grand of tax, they'll hold 100,000. They just build a buffer zone around them so they're not actually going to be caught short there. Make inquiries to the ATO. These buggers are amazing. I ring nowadays. They recognise me just by me talking into the mouthpiece. Okay, voice recognition. They already have a rating on me at the ATO. They don't share that rating with me. But they have a rating at the ATO, so they know who they're dealing with. I still need to go through and identify it. But if you're dealing with an estate administration and you're a bit uncertain, jump on the phone. Record it. Well, they'll record it so you can get access to it later. Make a file note. because it's demonstrating that you're making dual process, that you're actually making dual inquiries about what's going on, which is going to be able to defend where you are a bit later on. Advertise, you can advertise through the papers, going to administer the estate. The ATO is not really covered by that, but it's still worth doing. Indemnity, lawyers will say, look, why don't we just sign an indemnity and distribute stuff out? That's great. Has anybody tried to enforce an indemnity? $20,000, $30,000 to go to court to be able to, to start to enforce some of these things. And then you've got to have money. They've got to have money to be able to bring it back out. So again, it's a nicety, but make sure that you're sort of covered off. I have in the electronic stuff that you have in the material on this, a little bit of an ebook here. It's in your thing. It's on my website if you want. Feel free to download it, do whatever you like with it. That there talks around this executorial liability stuff and how important this is. So if you're dealing with a client with estate administration and they're going, oh, the accountant said it's okay, send them a copy of that. And just show them, hey, this is actually got to be taken really seriously. Your client will thank you for it because they don't want to lose their house on the way through all of this. So let's deal to capital gains tax around this. So on death, what really happens? So basically, normally when you transfer an asset to somebody, there's a capital gains tax event that occurs. On death, Division 128 says, well, hey, Ian's died today. As his assets pass across to the LPR, his executor, that's not going to trigger a capital gains tax event. And the same thing again, as it passes out ordinarily to beneficiaries, there will not be a capital gains tax event either. Now, it makes a bit of logic that if the estate was to sell, the executor was to sell that asset, it's a CGT event. So the estate needs to pay tax on it. If the beneficiary, my daughter Zoe, ultimately receives the asset and sells it, well, guess what? Again, it's a CGT event. It's a physical disposal that occurs at that particular point in time. Personal use assets like motor vehicles, motorcycles, house furniture and stuff, there's no CGT in relation to all of those assets generally, okay? So that's not something you really need to be worrying about. And a bit of an opportunity here for you guys, and just be careful this is not tax driven, but tax losses. If I've got capital losses in my tax return and I die, they're lost. They can't be used in the estate. All right, so by actually, whether it's income losses or capital losses, so you might turn around and say, well, I have a client with a beautiful portfolio here, there's $100,000 worth of losses. Well, maybe, just maybe, particularly towards the later part of life, you look at that and say, well, do we actually turn around, realise some of those gains now, take advantage of those capital losses, don't go and buy the exact same shares. It sort of smells when the ATO comes around, all right? But invest in something else, use that loss, because otherwise it's a loss that actually is lost. I had one in Melbourne recently, $500,000 worth of losses. And the guy was on his deathbed, and the family sort of called me into that, and there was a decision then made with their planner to actually go and sell some of those shares, but that was about $200,000 worth of tax saving we would have had on that, given those sort of circumstances that we would have otherwise lost. So just something to have a little bit of a look at through there. So what happens? We all know capital gains tax, smart room. September 85 is when capital gains tax come in. So basically, if I bought an asset pre-1985, it's capital gains tax free for me up to the date of death. My executor receives it today at today's market value and is deemed to have acquired at today's cost base. So any disposal of that asset going forward will be subject to CGT. If I bought it post-85, so let's say 1990, even though my executor and my beneficiary is deemed to receive it today, from a tax law perspective, they're also deemed to have acquired it in 1990 for the cost base in 1990 at that particular point in time. Main residence, one of the biggest assets of many estates, you're actually deemed, providing it was a principal place of residence at my date of death, you're actually deemed to have acquired it for market value as at today's date, when I die. If it was an income producing and it was my principal place of residence, and I'll dive a little bit further into this in a moment. But I just want a little bit of giveaway here for you, a little bit of a hint, is that what will happen is lawyers will often go and do an inventory and put that in with a grant of probate. Okay, so that'll be saying what the assets and liabilities are. And they want to get that done as quick as they can so things can get control of. So what will they use for the value of the house? The rates notice. All right? That might be here, the real value might be here. Now what's interesting about this is that you've just signed an affidavit, a court affidavit, a Supreme Court affidavit. So the Commissioner's going to go, that's great, I'm going to accept that because it's an affidavit. He will, however, accept, and this is the thing I just pass on to you guys, that if you go out and get a sworn independent market valuation at a higher value, he'll run with that. Not a real estate agent. A sworn individual market value, if you can go through and do that. Maybe then a good way of actually getting a little bit of a value for your clients through there. Capital losses I spoke of. Oops, have I gone backwards there? Nope. Capital losses I spoke of. Again, if it's an asset's disposed of during the estate administration, there's a deemed disposal. One of the other areas I really do want to hit up on, though, ladies and gentlemen, is small business CGT rollover relief. And I'm assuming most people are aware of the small business CGT provisions. Now, in a deceased estate, you have 2 years from date of death as the executor to access the small business CGT concessions. So if you're going to sell that business, you want to do it in that 2-year period because you'll otherwise fall on the other side, and if the ATO doesn't permit you to go forward, there is a discretion. You can go to the Commissioner and say, whoops, we missed it because of all these circumstances. It's really hard to get the Commissioner to agree to that, let me tell you from personal experience. He does occasionally. Then you're going to end up with a tax liability you could have otherwise avoided and professional negligence that's going to come along with that. So watch the 2-year side in relation to that. Right of acquisition under a will. So if I turn around and say, well, hey, Zoe, my daughter, I say, Zoe, look, out of all these assets in the estate, if you would like, you can buy the beach house. You have first right of acquisition. Otherwise, it's going to be sold and the proceeds going to be shared among all the beneficiaries. If she takes that right of acquisition, it's a disposal for CGT purposes. Double death. Really topic one at the moment that's going on around Australia. But double death, yes, you can die in an ambulance, they bring you back to life, and then you die again, right? That's not what I'm talking about here. What I'm talking about here is that mum dies, and then her estate's going to go to dad. But before her estate's administered, what actually happens is that dad dies. And so he, at date of death, the assets of mum were not dad's estate. They weren't his assets. So that Division 128, which I said the assets roll over from a deceased person to their executor to their beneficiary, it doesn't apply. It will apply from mum's estate to dad's estate, but when the assets roll out of dad's estate in accordance to the terms of his will, there's a CGT event. There's a transfer of assets to which 128 doesn't apply. We had a 7-figure CGT event in Melbourne the other week in relation to that. If that had been missed, the executor administered the estate and the ATO had turned up, that would have been 7 figures that executor would have been exposed to. So some fairly significant stuff going on through there. Yeah, absolutely. So let's just say I die. Okay, I die today, let's go there, and I've got $5 million worth of assets, just to make it that simple, okay? And they're CGT impregnated. And I'm giving them to my wife. Now, before my estate, so you're on my executor now, congrats. You go and get my grant of probate, you're trying to work out all this stuff, but then my wife dies. Now, what happens is that you'll still administer this estate, and ultimately you'll pass it to her estate. Okay, so her estate becomes the beneficiary. Now, when the people that are administering her estate go, okay, I've got all these assets, and I've got all these ones from Ian, when they go to pass that out to my daughter Zoe, the CGT event, the problem is that my assets at her date of death she didn't own. And so whilst they go to her estate without a CGT event, when they come out of her estate to my daughter, there's a deemed disposal because they were not her assets at her date of death. And that can be a really significant CGT event that goes on through there.
What about joint assets? That same scenario?
Well, it depends whether it's tenants in common or... joint assets. So the same sort of scenario that, she might own half of it in her estate, which could roll out, okay, without 128. With 128, but the assets, my share of that ultimately goes to her, unless it's by survivorship, there'd have to be deemed disposal of that as it went out as well. So it's a bit of a nasty one that happens through there, guys. And I just want to flag it with you to say that it happens all the time. The ATO don't get it, but it is happening all the time. People are dying within the same sort of timeframes and before the estate administration actually gets administered. I probably spoke about CGT rollover, so the 128 that it goes from me into my estate and then out to my beneficiary. There's some exemptions to this. Number one, if it goes to a non-resident beneficiary. 52% of Australians are first or second generation migrants. A lot of our kids are going overseas and living in things. If we do a distribution offshore, then what's going to happen? There's going to be a CGT event on there, unless it's what we call taxable Australian property, which I'll come to. A tax-exempt entity, a DGR, is excluded from this, but I'm really talking here about the Bowls Club, the Boys Scouts or something. An entity that doesn't have DGR status, but is actually tax-exempt, it doesn't need to pay tax as an issue there. Or a complying superannuation fund, if there's a testamentary gift to a complying super fund, which I haven't seen a great deal of, but does actually sort of happen. So just trying to get this slide thing moving. Yep. So what actually happens here, I want to have a little bit of focus on the non-resident beneficiary because this is perhaps the most usual one that sort of happens through here. So it'll only apply to post-85 assets, so impregnated assets that go on through there, and applies to non-taxable Australian property, which conveniently is not actually defined within the Act. So we need to go to taxable Australian property. And taxable Australian property is real property, real estate. It's things like mineral or petroleum rights or 10% of a holding of a company in Australia, which the majority of the assets are also taxable Australian property. So if you turn that on the head and you say, well, what's non-taxable property, Australian property? It's what you guys deal with, shares, managed funds, etc. And so if you go and actually do a distribution, in-specie distribution from an estate out to one of those beneficiaries, you're actually going to trigger a CGT event. And that's a CGT event K3. Where am I pointing this? Okay, CGT event K3. So what happens is your client's got all their shares and now you're going to transfer them to little Sally that lives in New York as a non-resident for tax purposes, and you go to transfer that, there's a deemed disposal that occurs on those shares. And it's deemed to have occurred as at date of death. So the executor in my estate, congratulate my executor again, I die, you go and lodge my tax return today because you want to lock that period the ATO can come after me, and then, or after you. And then you go through the estate administration, and then when you get to the end of the estate administration, if you're going to send them to little Sally, you need to go back to the date of death return, amend that return, and pay the tax before you transfer the shares. And if you transfer the shares without doing that, the ATO will come knocking on the door and the executor will again be personally liable. But there's a problem. I spoke to you about the amendment periods, 2 to 4 years. So estate administrations can often take greater than 2 to 4 years. So if you exceed that time frame, you're statute barred. You can't go back and amend that tax return. The Treasury know this, the ATO know this, the federal government know this, and they were going to change it, but at the end of the day, it wasn't changed. So if you fall outside of that amendment period, then you've got a tax-free gain that's going to occur at that particular point in time. I wouldn't delay state administrations to take advantage of that, but it does happen, and things like life interests, testamentary trusts. If I left a life interest for my wife in a trust and ultimately daughter's going to get the capital of that, my wife might live for another 15, 20 years, and therefore well and truly statute barred in relation to that. Main residence. Classic guys, if my main residence at date of death, you now have 2 years in which to sell and settle. And I emphasise the word settle because it's the only part of the Act that says that. And if you settle that property within 2 years of my date of death, no capital gains tax. Freebie. Doesn't matter, even if you've rented it for 2 years during that particular time, that's okay. The rent's income that you need to pay tax on, but the capital gains tax is not going to be there. That can be extended. And it can be extended in the case where my wife lives in that property, whether it's in the estate administration or subsequently. If my spouse lives in there, that exemption is going to go even further. An individual with a right to occupy the property, so under the will I might say, hey, this gentleman here, you can live in my house for the rest of my life, but when you finish with it, it goes. Now, as long as you're living in there and my will gives you the power to live in it, it's exempt as long as he lives there, even though we're not related. I'm not going to give it to you, but anyway, yeah. Or an individual inheriting a property. So you now inherit my property. As long as you move in as soon as practicable after the estate administration, it will be exempt during my ownership, during all of the estate administration, even if that's years. As long as you move into it as soon as practicable after the estate administration, it's actually going to be exempt. Now, what's really important here is that for post property, so my property, if it was a post-85 property, it wasn't income producing as at my date of death. If it's a pre-85 property, these provisions really don't apply. But here's another little secret gem. Because these provisions, the 2 years disposal, do apply to pre-85 properties. But it doesn't need to be my principal place of residence. So I could have 5 investment properties, residential investment properties that are pre-85, plus my own property, 6 properties. And I have 2 years post-death as executor to sell all of those properties CGT tax-free. But it's only available to pre-85 residential investment properties. Just a nuance in the legislation that goes on through there. So some other considerations. Since 2008, 2009, the Commissioner's had the power to extend that 2-year period. He's got a discretion. You need to write to him a lovely letter to explain the scenarios, and he may actually extend that discretion for you. An important one for you guys, 6 years absence exemption. So if you have a client that you're working with and you're putting them into a nursing home, the family doesn't want to sell the house, you rent the house out, this happens, okay, you rent the house out, get some income sort of thing, then for 6 years after that person leaves that home and goes into a nursing home, the executor has the right to turn around and say, that's principal place of residence. If you don't you don't rent it out, but you let the granddaughter or grandson live in there and they just meet in costs, that's a private arrangement, all right? It's not rent, it's not accessible, and that's indefinite if the property is left vacant. Now, the thing to be really careful here is aged care facilities, particularly around those retirement villages where you need to read the contract. Some of those you actually take an equitable interest in that entity. And if you do that, that could be your main residence, and therefore this won't apply. And if you're giving advice around these scenarios, just put in the back of your mind, what happens after 6 years? And make sure you put a statement in there to say that basically after 6 years, any growth in this asset will be subject to capital gains tax. That effectively has on a day's basis, just to cover yourself off in relation to that there. I've got there that you can only have one main residence at any time. That's a fair enough scenario. And it can conclude up to 2 hectares of land. Now, what's really interesting about this is that land doesn't need to be the land under the house. Yes, the house has got to be part of it, but it might be a block a kilometre up the road. And as long as that falls into the 2 hectare zones and that's sold at the same time, and that block is being used for personal use and enjoyment, and sold at the same time, I'm repeating that again, then that can all be CGT exempt in relation to that. Okay, so just watch that, and sometimes you find a house that's actually a little bit over 2 hectares, which sounds strange, but you need to go through and actually proportion that. PCG 2019/5, this is another one that I consulted with, and what this is doing is, what was happening is the 2 years, where you could go to the Commissioner and say, I want you to extend my discretion, he was getting so many applications for that, a lot of them from my office, that he's gone into stress down mode on this stuff, right? And he said, we've got to be able to extend this. That's PCG extends it. It's mentioned in the book. It'll give you another 18 months, so 3.5 years if you meet certain criteria. It also sets out in the PCG, which is mentioned in the book, what you need to meet for the Commissioner to be able to extend that discretion. Now, that 2-year discretion, that if you exceed the 18 extra months, so 3.5 years, you can still use that 2-year discretion. And I've had cases where I've been able to do that up to about 10 years based on the circumstances. All right, you're not always going to get that, but read that material if you're going down that particular track. Superannuation death benefits, something that you'll be all very familiar with. So trustee of the superannuation fund, as you all know, is required as soon as practicable after death, remember to pay out those particular members, those as soon as possible upon death. It can come out, I know I'm preaching to the choir here, it can come out as a lump sum payment or it can come out as an income payment. Lump sum payment can be paid to the estate or directly to the beneficiaries. The income payment cannot be paid to the estate. So the estate isn't necessarily going to get the superannuation fund. That's strategy, and you guys would be well aware why you do that at times. But if it does fall into the estate, then it becomes an estate problem. Now, we then need to say, well, what's this all about? So what happens is the industry super funds, and you're probably seeing this yourself, is the industry super funds, if they make a payment out directly, they have to work out whether a person, well, they have to work out the tax on that, whether a person's a non-dependent or a dependent or an interdependent, which I'll go through in a moment. They're liable for the tax. If they pay it to the estate, they don't have to worry about tax. They put it onto the poor old executor to go and work that out. And you'll see industry funds where they can, either binding death benefits are bound to it, might be hardwired in the deed, or it might be at their discretion. And that's where they come to here with the discretion, where they try to go through and push that. So again, I've got there, if it goes to a dependent, there's no tax payable. If it goes to a non-dependent, there's going to be tax payable by the LPR before they make that particular payment out. So we need to have a look at what's a tax dependent. Now, the SIS Act and the SIS Act and the Tax Act is slightly different on here, but you can sort of see all the way through there, your vanilla family, spouse, child under 18, child over 18 and financially independent is not, but 18 to 25 and financially dependent is going to be classified as a dependent for tax purposes. That's your normal vanilla family. So what we're trying to do here is to push people into that area to sort of like go, well, if you're a dependent, we don't need to pay tax on this amount of superannuation. You then start to go, well, we've got areas around a disabled child, an interdependent relationship, which I'll go through in a moment, or a financial dependent as at date of death. And so we're again trying to get as many people into those areas as we can. Financial dependent, again, conveniently not defined. So we need to start looking at this. We need to look at case law, AAT decisions, And it really goes from everything from necessities of life to a standard of living. The case that I mentioned there is just a random case. This lady was on a sickness benefit from the federal government. Okay, so most people would say she's okay. Her son, who died, was actually giving her a bit more money. And so when he died early, she was deemed as a dependent because it was about maintaining her level of life. But you can see other rulings where the ATO hasn't applied that particular rationale. Interdependent, on the other side, have a close personal relationship, living together ordinarily. There are exemptions I'll come to. And one or each person is providing financial or domestic support of the other. So if you can start to fall into that regime, again, you could say this is an interdependent. Go to the ATO private ruling database and have a look at how many rulings there are in this stuff. It's off the scale. Okay, and that's because executors don't want to have the exposure of trying to work these scenarios out. It's then going to go down, well, what's the tax payable? It's going to come down. You guys are very well familiar with these elements, whether it's taxable, untaxed, or tax-free. You can see there tax rates 0, 15 or 30%. The executor is going to have to deal with that if it's going out to a non-dependent. Little takeaway here, guys, and that is to say if you've got super proceeds coming into an estate, I strongly advocate that you put them into a separate bank account. Because if you're having an argument or you're trying to say the super proceeds have gone to mum who's a dependent and all the dividends and interest have gone to the other beneficiaries, okay, and you're trying to say this is for mum because it's tax-free, you need to be able to demonstrate she got that money, not all the money grouped in one sort of fish pond, intermingled with dividends and interest and all that. And the Commissioner will turn around in those scenarios and say, no, mum didn't receive 100% of that. She received a part of the shares, the dividends, plus the super death, as did the others. Again, legal community is starting to wake up to this, but if you're in those scenarios, please have a little bit of a look at that. Foreign superannuation funds. So what's going on through here is that payment to a foreign superannuation fund. We're not the only ones that have got super funds in the world, as strange as that may sound. So people move to Australia. As I said, 52% of Australians are migrants into Australia. And so you're sort of going, well, it makes sense that they may have offshore superannuation funds. Those offshore superannuation funds are what we classify as non-complying super funds in Australia. That is, they don't comply to Australian rules. And so for all intents and purposes, it's going to be a non-resident trust. And therefore a distribution from that trust would ordinarily be taxed here in Australia on death. Now I've got there that section 305 of the Act, what this does is sort of said, well, okay, well, if that was paid out within 6 months of somebody coming to Australia as an Australian tax citizen, we're not going to tax it. Okay, so if they take it out as a lump sum themselves, living, or if their executor takes it out in that 6 months, no tax. But if it's outside of that 6 months, whether it goes directly to the beneficiary or it goes to the estate, there will be tax payable on it. But the law effectively draws a line in the middle and sort of says, well, any of this income earned before them coming to an Australian citizen, that won't be taxed. It's only growth in income past that particular point that's going to be taxed in Australia. So just watch that as that sort of goes through on the way out. So a little bit of a case study here that I'd like to just show you just to try and bring some of this together. And this was a Victorian-based matter. And so in this particular case, what happened was that the deceased here was he lived in a really nice house in Toorak in Melbourne. Those from Melbourne will understand it's a very affluent sort of suburb. The house was worth a few $1 million. He was living off the age pension and he had a small share portfolio that he was subsidising his pension. He appointed a law firm in Melbourne, the partners of a law firm in Melbourne, as the executors. Now, this law firm is a very prominent law firm in Melbourne. And what the partners did, they've changed their policy since, is they actually made a grant of probate, application for probate, and named every single partner on the grant of probate. So that was over a page of names, all right? Because they're thinking, hey, this is pretty simple. Okay, there's a house to sell, 2 years, exempt, bit of shares, whatever, and then we can distribute this off. We're going to make an absolute fortune on this. And what there were 2 offshore beneficiaries in Japan because this guy was originally from Japan. So they've got the estate, they've got all this stuff, and they started to go through his house, and they found some credit card statements. But it was a Japanese credit card. And they've gone, wow, what's this? And he was living a high life on this credit card. And they traced that credit card back to Japan, and there's a bank account there to which he'd bought this really big annuity, which was paying monthly into this bank account. He also had share portfolios in 5 other jurisdictions around the world. Okay, and so all these dividends were coming in from these into this bank account. The guy was living like a king. But in Australia, it was only the age pension and a little bit of a share portfolio. These guys, there was another $1 million share portfolio here in Australia in which he'd never quoted a TFN, and it wasn't any of his share broker stuff as well. So I got this stress phone call from a senior partner for the firm saying, look, can you come in and have a conversation? And I've met with a lot of their partners in the firm because they now, every one of them was on this register, grant of probate, they were all personally liable for this, all right? That's why they've changed their sort of areas. And when we had a look at this guy had been living in Australia for 20 years, hadn't applied for a tax file number, and hadn't lodged 20 years worth of tax returns. All their years of profit was very much in question. So what did we have to do? We had an obligation for 20 years worth of tax returns. From when he connected to Australia, his global assets and income is taxable here in Australia. We had to reconstruct his global income. That meant resales of probates in all those other jurisdictions, actually a new probate in a couple of those jurisdictions. Capital gains tax, we had to work out the capital gains of anything he's sold off all of those areas. This took months. It was well over a year to reconstruct all of this. I went to the Moonee Ponds ATO in Melbourne. I meet with the ATO quite a bit, as you can probably imagine, and went down and met with a couple of their senior staff and their personnel and said, look, we've got a little bit of a problem on here. here it is. So they've said, look, thanks, Ian, that's all good, leave it with us for a tad. And they've gone off and done their own due diligence, which was another many, many months of due diligence. And they called me back in and they said, look, you made a mistake. I think it was $23 worth of bank interest I'd missed off one Australian bank account. It was all in jest. But in the end, what we ended up doing is we ended up settling with the ATO on that matter for just over $1 million worth of tax. Okay? Not only that, because the ATO systems automatically generate tax interest and penalties, the penalties on this also exceeded just over $1 million of interest and penalties. All right? So it was a really, really scary time for the executors. Now, in this case, the ATO agreed to write that off. We ended up paying 20 odd grand worth of interest or something. Because the extent that the executors had done on a global basis to get this right was commendable by the ATO, and they were happy to write it off by application. I have a matter in South Australia right now where a widow, so an old lady, she's in her 80s, late 80s, she's on the age pension legitimately, one of her friends died, she's administered the estate. There was some outstanding tax, a local accountant worked that out, lodged tax returns on all these years worth of tax, told her, okay, there's $100,000 worth of tax. She's withheld that, given all the money to a charity, and the ATO's turned up and said, well, look, it's not $100,000 you owe me, it's $300,000. Now, in that case, the accountant's gone shit, the lawyer's gone shit, excuse my language, and they've rang us up and they've made an application, the ATO knocked them back. So I've gone a bit heavier, higher up in the ATO and said, guys, this isn't fair and equitable, this is not right. They've refused to still withdraw that. So that house here in Adelaide, this poor old lady, she's at risk of losing her house. I'm pretty pissed off with this, and I've gone straight to Karen Payne, the Inspector General of Tax, who's now in discussions with the ATO in relation to this. But it just goes to show, make provision for those tax and the interest on the way through. Just in closing, before we go to questions, I just want to pick up a couple of things. Law Council of Australia, I do a bit of work with the Law Council of Australia at times. The highest area of growth and litigation in this country is around deceased estates. Beneficiaries suing executors coming after professional advisors, etc. It's right. It's litigation, man-mind. 12 to 14% of interpretive advice, if you go to the ATO, their latest stats, is actually on deceased estate matters. That's disproportionate because the overall tax revenue in Australia is between 3 to 4% of tax revenue comes from deceased estates. It's a complex area and there are a number of mind traps within there. I want you to keep an eye out for business and investment structures, the companies, the trusts and those things, the small business areas. They add complexities here. The international aspects, again, 52% of Australian society, first or second generation migrants. There are going to be offshore assets that haven't been declared. There are going to be offshore executors, offshore beneficiaries. Every one of those changes the tax outcome that can happen here in Australia. It's really quite complicated. So keep a bit of an eye out on that. In relation to you guys, in relation to some takeouts on this, I think that really you need to be considering the advice that you're giving your clients, both now to say, well, how does this go through from an intergenerational? How do we deal with the intergenerational transfers here? Are there capital losses through there? Clients for life really was part of the theme of this, and that is that if you manage this correctly, you have these amazing relationships with your clients. Look after those relationships. Their spouses will come to you, and then hopefully the next generation will come to you and try and get some comfort, because you're the one that knows their affairs better than anybody else. And by doing that correctly and pushing them or directing them in the right directions and bringing some of these areas, hopefully you'll be able to retain the next generation as that intergenerational wealth transfers sort of occurs. Big believer on collaborative practice. That is that it takes multiple parties to come together. You guys have some expertise I can't even understand, and it's not my area. You need a planner, you need a lawyer, an estate lawyer, you need a tax accountant in these sort of areas for estate planning or estate administration. So I think surround yourself by good, capable people in that particular area through there. Cost-based information, if I can say anything to you guys, please, with your clients, make sure they've got their cost bases. Tens of thousands of dollars can go up in trying to re-establish cost bases in the estates. And that's not a way to win the next generation. Yeah, you know, because mum and dad didn't keep it and you just couldn't be bothered. Force mum and dad to do it, and you hopefully will retain the next generation. Executive roles, this is one I want to touch on, and that is just to say that from an accountant, and you guys need to look at it from your financial planning perspective and understand that, you know, there's not a lot out there on this, but as an accountant, my professional indemnity insurance doesn't cover me as an executor. And a lot of accountants will go out and act as executors and not realise they got no cover. I've seen accountants pretty much lose their business overnight because the estate litigation has got so big, all they can do is focus on the estate administration. If you're going to take these roles, it's an honour when a client turns up and says, can you be my executor? It's a real honour, right? But at the end of the day, you've got to go, do I have the skill set? Do I have the insurance for this? Am I going to be remunerated? Because even in their will, if they say you're going to be remunerated, that can be thrown out by the court or it can be challenged by the beneficiaries. So you need to look at these sort of scenarios and say, well, do I just say to them, look, why don't you put in your will, and I'll just put this out as another comment, why don't you put in your will that to the extent that, or when you do die, that they instruct their executor to come to you for advice in relation to their affairs. So you are party of it, and you're not on the wrong side of that sort of goes on that sort of basis. So I just implore you to have a little bit of a look at that. I won't take the executorial roles, and implore you to just maybe reconsider your own position on that. And I've got 32 seconds left of my time, so that's really, really impressive. I'll just pass back over for any questions, yeah.
Wow. I can only say wow. I told you were in for a treat, didn't I? So I was going to ask you to be my executive. All right. So some questions. Now these have been voted up, so let's go with the one most voted. So what is the process, Ian, from paying CGT due to a non-resident in-specie distribution if there is no liquidity in the estate?
You're forced to sell the asset. You're actually forced to sell the asset because if you fail to sell those share portfolios and you distribute, you're personally liable. There's a law firm in Brisbane, $90,000. The principal was an executor. They missed the K3 event. Other law firms had, so that executor actually had to pull 90 grand out of his pocket to pay the tax. Okay, so you really need to sell it. You wouldn't take the role as an executor.
You're not at all.
There's not enough money in it. For those leaving, there are some books at the back there, first in, first serve. For anybody that there's no books left, there's a page there if you put your details on it. There's no marketing coming to you guys, I promise you that. We're happy to send you a copy of it, so okay. Sorry.
Oh, and if they run out, we'll get your name and then we can send you one.
Yeah.
So at what stage will the Australian government introduce a broader inheritance tax scheme similar to the UK?
This is awesome, and I could talk for an hour on this point by itself. It doesn't work, okay? It will probably come in because it's politically sensitive. It's about the tall poppy syndrome to bring it out. But if you start looking at the OECD world, there's 13 countries in the last few years that have actually left and exited death tax. You need death tax, you need inheritance tax, and you need gifting tax. Well, death and inheritance are the same thing, but you need the gifting tax. And it's been demonstrated time and time again around the world that the cost of actually administering this stuff is so big that the actual benefit's not worth it. If they lifted GST, and I was on an ATO conference one day and the ATO was saying, well, if we actually lift GST by 0.5%, we'd end up with the same result. Politically, I think it will come, because what will happen is it's only for the tall poppies. They're not going to get mum and dads on this sort of stuff. They can't afford to. It's the real tall poppies. But those tall poppies have professional advisors that set up all these amazing structures to be able to avoid this stuff. and they need to be able to pursue that. I think it will happen. It is on the agenda of both political parties. Treasuries have modelled this many times. It'll happen because of the tall poppy syndrome, but economically, tax-wise, it doesn't make sense for Australia. Great question.
Good question. So with respect to the 2 hectare rule, do they have to be on the same title or completely different titles?
Different titles is fine, providing it's being used for personal use and enjoyment, up to 2 hectares, and that they're sold at the same time. Doesn't necessarily need to be the same buyer, they need to be sold at the same time. And sorry, one point just on the house, because we've hit the house, I wanted to draw your attention. Do not demolish the house, all right? The exemption applies to a principal place of residence, which implies a residence is in situ. I've had cases, 3 of them around Australia now, where the family have felt that, and lawyers are now on the gun for it, families have felt that demolishing the house will actually put more value to the land. All of a sudden, the house is no longer, main residence exemption doesn't apply. Mum and Dad bought back in 1989, subject to capital growth that entire period.
So you talk about demolishing the house. How about if, does the CGT exemption apply to primary residence if there was significant capital improvements made after death?
That's okay. It's okay if you want to do that. But one of the things in the PCG 2019/5, which I mentioned in the book, to be able to self-assess, to be able to extend that period, is that you can't delay the administration and make more profit. But if you can do that in a 2-year period, families do it. They paint, they renovate, they put a new bathroom, new kitchen in. If you can do that and sell and settle in 2 years, you're covered. But if you go over that 2-year period, the commissioner's going to go, no. This is not because the estate administration's been complex. This is because you're being greedy. And therefore, you're not going to get the extension.
Very good. And what happened with the client? So everyone know about this client example that you had of paying back the $1 million tax. But what about the overpayment of Centrelink benefits? What happened to that?
Yeah, and I think I made a comment on the slide there I didn't talk to. There was a discussion with Centrelink. The lawyers had to go and do that. And I'm assuming it got paid back. By that stage, it was such a small part, I stepped off the stage at that particular point. But they were very relieved to have got that matter dealt with. But yeah, there would have been an adjustment with Centrelink.
Oh, fair enough. Okay. Why, when can advisors get access to the tax agent portal? Now that you're...
This is complicated, guys. So to be able to deal with the tax agents portal, the legislation requires that you actually have a tax licence. So if you have a tax licence, no problem. The provisions actually do also allow lawyers, which is quite ironic, to get access, but not to actually provide tax advice. It's an area of landscape, there's quite a lot of discussion that's going on, but what's underlying all of this and why the ATO won't actually disclose a lot of this stuff is they're bound by that legislation. And what's not publicly known a great deal, you can read the Act and you'll be able to see it, is if an ATO officer gives tax data information to a person that's not authorised by the Act, 2 years jail. So the ATO have a policy in-house, they go over this every few months in-house of training about you can only give data away to authorised people. And unfortunately, planners aren't on that list at this point in time.
When can we be on the list?
The Act. I can't speak to the ATO. Yeah, no, I agree with you. I mean, reality is that for you guys, you're dealing with your clients' affairs. You know their affairs. So to be able to tie that in and to be able to help with these things would greatly assist. It'll take longer to get our tax returns back.
Okay, the questions are flooding in, right? Yeah.
I would need to read the legislation on that, to be honest. I don't know whether you need to be practising or not, or just qualified. Happy to look it up in the Act. If you send me something, I'll write to you. Yeah. Send you a thing. Yeah, good question.
All right, any tips for clients whose beneficiaries are not Australian residents? And what are the general tax strategies to be aware of here around distribution to optimise the tax outcome for the estate?
Can you just repeat that?
Okay, yeah. Any tips for clients whose beneficiaries are not Australian residents? What are the general tax strategies to be aware of around distribution to optimise the tax outcome for the estate?
That's a really great question. So I've talked about shares. If you transfer shares offshore, there's a CGT event, a K3 event that occurs, okay? But shares aren't often the only part of the estate. There might be a principal place of residence, there might be cash, there might be term deposits. And so many wills will have these clauses around appropriation, and what they allow you to do is to appropriate certain assets in certain directions. As long as the will says everybody has to get 1/3 of this estate, you might be able to appropriate the cash to the non-resident, or the sale proceeds to the house, and the shares here in Australia to an Australian resident. Now, they'll be impregnated, because when they sell it, there's still a CGT liability in there, but that liability is in the future, and you might be able to adjust on that sort of basis. Not all wills have these provisions, but every state and territory has a Trustee Act, and the clauses, and you need to go to your relevant jurisdictions, but most of those also have a power of appropriation that would extend the terms of your ability to be able to do those things. So I think it's about looking at it and going, well, what do we do on this? And I could talk about the non-resident stuff, but if it was only a non-resident beneficiary, okay, it might be worth actually appointing a non-resident executor, because if the non-resident executor sold those shares, not the beneficiary, it wouldn't be taxable here in Australia. Okay, so this is, I could do another hour or two just on that, but there's a whole heap of methods to look at it. But I think what the thing is, before getting a grant of probate, have a look at who your beneficiaries are, what your assets are, what it's likely to be, and then start to say, well, really, should that person get a grant of probate or not? And how can we maximise this to avoid some of those tax outcomes?
Now, this one relating to the one of the examples that you had, many pensioners pay no tax and therefore don't lodge a tax return. And with rising interest rates and just pensioners being on the full pension and just $200,000 of assets, and let's say bank interest of 5%, when will they start having a tax liability with the estate? And when will that be when will the estate be liable for that? Because it's very small.
It's small, but I think you've also got to look at this and say, well, the Commissioner doesn't like being on TV for the wrong reasons, all right? So my Adelaide example here, that's another avenue, and I wouldn't do that as Commissioner because I've got some very good relations there, but, he wouldn't like to see that on a TV channel, current affair. Are they going to be spending resources? I mean, they can't deal with big tax issues, let alone really small tax issues. Are they going to be spending resources, trying to pursue $10 worth of tax in this year, or $20 in that, or $200? Very unlikely in the current area. We did talk about AI earlier. AI may change that coming up. But you've got to look at the risk, but you've also got to look at it and go, well, hang on a minute. If the beneficiary, so myself and Claire die and Zoe's my only child and Zoe gets my executor, if she looks at that and says, well, actually, maybe there's a couple of if questions in there about mum and dad's tax affairs. If she ignores those and takes the proceeds, she's still got the assets. So if the ATO turns up, she's the one that's in for the bucket and she's got the assets to be able to make that payment. But if I appointed this gentleman here as my executor, and then he passes the assets across to Zoe, you're in the bucket. So sometimes you've got to take that commercial overlay and sort of go, well, really, it's such a small amount, the beneficiary is receiving the assets, they're the executor, maybe it's not worth pursuing. Is the ATO going to pursue me for $5? There are times when we won't lodge tax returns because it's going to cost more to lodge the tax return than it is to actually get the tax refund. There is a commercial overlay, and please do not repeat that. Any ATO staff in the room? Sorry.
Well, on the matter of executives, and now that we don't want to be executives, now that you've said all this stuff, can they access any relief if they did seek advice, as an executor, seek advice from a lawyer or an accountant?
If you go and get professional advice, so somebody comes to me or they come to you as a planner or a lawyer and they get professional advice off you, then, they have your PI cover. And we'll put letters of advice together for the courts and sometimes in mediation or just even to administer an estate. And the entire thing is that they want my PI cover. Okay, and that's fine. But the reality is the Commissioner will still go them in relation to it. They will then need to take an action against me once they settle with the Commissioner in relation to that. And so it's a cost. It's a lot of effort to go and do that and a lot of money. But yes, sometimes by just working with a professional, getting things in writing, that might give you some of the cover you want.
Yeah. Okay. So public trustees typically charge 5% to administer the estate. Is that a viable amount for a professional advisor to charge for fulfilling the role of an LPR? If we decided.
Look, no, I really probably can't pass too much comment to that. Look, as I sort of alluded to earlier, I mean, you can have a client that puts clauses in the will that sort of says you're going to be remunerated for X amount of dollars. That can still be challenged by the beneficiaries. And the public trustees and the listed trustees, perpetual, Australian executive trustees, etc., they have a sliding scale, so the higher the wealth, the lower the percentage that they'll actually take. But you've just got to be really careful that no matter what you put in that will, it could be challenged, and you may end up not getting very much at all if there's a claim against the estate or that's actually challenged. And you may underestimate the amount of time that it actually takes to administer an estate. You might think it's simple, but then you've got 3 kids that nobody knew about that turns up. It's happened.
All right, I'm gonna end on a philosophical question, like I always like to. There's too many questions, so do stay back if you want to ask Ian some questions yourself. So, do you think the death benefit tax will ever reduce from 15% plus Medicare levy?
No.
Oh.
And the 15% tax, let me tell you this, 15% plus Medicare tax, that's if it's paid out directly. So here's a little takeaway. If it's paid to the estate's not subject to Medicare level. So it's 2% tax saving. But by paying it to the estate, you're now exposing that asset to a potential family maintenance claim. I don't think they'll go back. They're being harder on super, and we all know that. So, yeah.
All right. Well, I think it's a wonderful session. Thank you so much.